Alright, so this is part one on how to repair a losing stock position using options. So if right now you have a losing stock position, or maybe you have several losing stock positions, then you definitely want to watch this video all the way to the end, because I'm going to share with you how you can increase the chances of you break even and even increase the profitability of your stock position using options. So before you repair your losing stock position, we want to first understand the term repair. What does it exactly mean? So repairing your losing positions just basically mean to lower the average price of your stock by buying more shares below your entry price. This is the essence of how you actually repair your stock positions, because if your average price is lower, then it means that you can easily break even. So for example, if you bought your stock at $100 and the price right now is at $80, you're down 20%, right? For the stock to get back to break even, it has to move $20, and $20 on an $80 price right now, that is a 25% move. So it has to move 25% upwards in order for you to break even. But if you were to just buy another 100 shares right now, if you were to buy again right now at $80, your average price would become $90. So now it only has to move up $10 for you to break even. So that is just 12.5%. Is definitely much easier to achieve compared to a 25% move in the stock. So what do you want to repair? So first of all, it increases your chances of break even, like I explained earlier. A lower average price means your stock does not have to move as much just to break even. It also helps increase your profitability when it's above your average price. So if your average price is $90, let's say, and if you had 100 shares before, every dollar move would just mean $100 in profit, right? But if you average in and you bought another 100 shares, so now you have a total of 200 shares. That means that every dollar above your average price would be $200 in profit. So it increases your profitability. And it's also a good deal, because if you think about it, the reason why you want to get into your stock position, and I'd assume that you are investing in these stocks for the long term, is that, you see, the mentality is that if you waited for the stock to drop to $100, you wanted to buy it because you thought that was a good deal. Otherwise, you wouldn't have gone in the first place, right? So if you like the stock at $100, then you would love the stock even more if it dropped to $80 or $60 or even lower than that, right? So that is a good time for you to buy again. Because if your idea, your direction of the stock is that it will go up in the long term, then it makes sense for you to just keep buying as it drops, as long as you got your risk management in place and you have enough capital to hold on to the stocks, right? Now, this is very important to understand. While repairing your stock actually increases your chances of break even and also increases profitability, it also increases your risk. That's because you're actually adding more capital to the stock, right? You're adding more and more money. So if you had 100 shares at $100, your capital was $10,000. And if the price drops to $80 and you buy another 100 shares, then you are adding another $8,000 in capital. So now your total capital that you put into the stock is $18,000. Now, if for some reason the stock does go to zero, you would have lost the full $18,000, compared to if you hadn't repaired the stock, you hadn't bought again, you would have only just lost $10,000. So this is very important to understand. So while repairing means you are increasing the chances of break even and increasing your profitability, you are also increasing your risk. That is why you only want to repair stocks that you're confident in investing for the long run. You don't want to be repairing on stocks that you're unsure of, that you're not or if the stock is a speculative stock, you're not sure whether it's going to go up, then that's not a stock that you want to repair on. Instead, you might just consider either reducing your position, or you might just want to cut the position altogether and take a loss on it. All right, so repairing is only if you want to invest in the stock for the long run. So here are questions that you want to ask yourself before repairing a stock. So the first question is, has there been any fundamental changes in the stock? Like, for example, maybe the business direction or the business focus has changed, right? They may pivot from one source of profit to another source, and if this fundamental change is not something that you think may work out in the long run, then you might not want to repair the stock, because you're not sure how it's going to turn out. You're not sure if the stock will still be profitable in the long run. Meta, which is formerly known as Facebook, they had started to invest very heavily into the metaverse world. Now, there are some investors that feel that they have sort of changed their fundamentals, because previously they were just focusing on their ad revenue, through the Facebook platforms and also other advertising channels that they have acquired over the years. So metaverse seems to be something new, and some investors just see that as a change, and they may not think that it's going to be profitable, because at this point in time it is still considered a bet. We're not sure that metaverse could work out where people will actually adopt metaverse and everyone will start using it. So if you're unsure, some investors might just want to cut the losses on Facebook, on Meta, or they might just not repair it. So it is your personal view. Next, has your view on the stock changed, right? Some people might say that, hey, metaverse is the next thing. It might be a revolutionary thing where it can change the industry and everybody will start to adopt it, right? Always the first mover of an industry tend to be successful if it does catch on. If it catch on, they're the first mover, they'll normally get the biggest market share. So has your view on the stock changed? If your view on the stock has changed, you think that it's not going to be as profitable in the future, then you do not want to repair on the stock. You might just want to just hold on to the stock and see what happens, or maybe just reduce your position. And finally, and most importantly, is that do you have enough funds to allocate to the stock? Because if you want to use options to repair your stocks and buy more, for each option you need to be able to buy 100 shares of the stock. So let's say, for example, if this stock has dropped to $80, you want to buy this stock, you have to buy at 100 shares of it, and the total capital for that is $8,000. So you want to make sure that you have $8,000 to put into this stock at this price. A lot of people, or rather I see some people that have been teaching regarding repairing, they're thinking of just selling premium on the options, but they are not thinking that if the option was to get exercised, they have to fulfill on the whole 100 shares, right? They just try to scalp here and there just to reduce the cost price of the stock. Now, it definitely works fine if you know what you're doing and you're able to cut when it goes wrong. But if you're not sure and you don't know how to manage it properly, it can really get deep into the money on your option, and you're going to get exercised, and during that time the broker is going to ask you to put up that money to buy that 100 shares of stock. And if you do not have the money, then it may run into some trouble. You may be asked to liquidate most of your position, and you may have to cut loss on your stock when it could actually go up many years from now. So this is very important for you to understand. So there, in general, right, just 3 ways to repair a losing stock position. So the traditional way would be dollar cost averaging. So dollar cost averaging, if you don't already know, is basically just putting a fixed sum of money at every fixed interval. Let's say every month you put in, say, $1,000 to buy the stock, regardless where the stock is, right? So at this point of time, when if the market has gone below your entry price, any amount that you put in to buy the stock would always be resulting in a lower average price. So this is on a fixed monthly basis with a fixed amount of money. Next is price averaging. So price averaging basically just means to buy as the price drops. So instead of using time to enter into the market, which dollar cost averaging is, price averaging just based on the price. So if you're at $100, it drops to $80, you enter. It drops to $60, then you enter again. So that is basically price averaging. And the third way is through options, and in my personal opinion, is the best way for you to repair, because you're able to collect some premium on it. And most of the time when we talk about repairing, we generally want to collect premium. But I'll also share with you another method that is not premium collecting, but helps you reduce your risk on the downside and have some leverage on the upside as well. All right, so there are 3 option strategies that I'm going to share with you that you can use to repair losing stock positions. Now, the first method is the cash secured put, So the cash secured put is simply selling a put option and having enough funds to purchase the 100 shares per contract of the underlying stock if exercised. So very quickly, a put option is just the right to sell the stock at a certain price. If you buy the put option, you have the right to sell the stock at a certain price. So basically, that's what a lot of investors use as a way to insure their portfolio. So if you bought a stock at $100 and they bought a put option at $90, and if the stock was to drop below $90, it just means that they have the right to exercise the option and sell their stock off at $90 should the stock drop below that, right? So this is a form of insurance. Like if the market was to crash all the way to $50 on your stock, you could exercise the option and you only lose $10 per share, right? So this is the cash secured put, but what we're going to use it is we are actually going to sell the cash secured put to get premium and then use it as a form of getting into the stock at a lower price to lower the average price of our stock. So that's the cash secure put. So the idea here is to continually reduce the cost basis of the stock. So I'm going to give you a visual illustration here so you can better understand what I mean. So this, imagine, is just well, this is my diagram at least of a stock that is moving up. Okay, so you see the stock is forming a higher high, higher low, higher high. So at this point in time, you might think that, hey, the stock is going up, so I want to wait for the stock to retrace, to pull back, then I will enter. So true enough, the stock has pulled back, it has retraced, and you decided, hey, I want to buy 100 shares here. So you buy 100 shares here and the price is $100. So at this point of time, let's say the stock started to go up, you think to yourself, maybe, hey, I'm a genius. Then all of a sudden, the stock crashes, the economy is not doing well, Fed raises interest rate, all that stuff, the news come and there's a big crash, and now the stock has dropped way below your entry price. So what do you do now? So the idea here is to sell a cash secure put. So let's say you have identified the level that you want to enter the next batch of 100 shares that you want to buy the shares at is at $80. So what you do, you sell the cash secure put, and let's say you collect $1 in terms of premium for it. So this dollar of premium will offset the entry price that you bought at. So now your average price would be $99. So let's say the market starts to move and at expiration date it closes above your cash secure put of the strike of 80. So what this happens is that your cash secure put now expired worthless. You collect the full $1 and then you can sell another cash secure put at the same strike. Again, maybe you collect $1 in credit. So this dollar again will contribute to reducing the cost basis of your stock, and now your average price becomes $98. So then again, you let the price move, then again the price, it may drop below your option very briefly, your strike, and then goes back up and closes above again. Again, what happens? Your cash secure put expired worthless, you collect the $1 credit. So at this point, you can then sell another cash secure put at that strike price. So you get the point. You just want to keep selling and selling and gradually reduce that average price until you finally get exercise on the cash secure put. Now remember, our goal with the cash secure put is to get exercise. We want to get filled at $80. We want to buy 100 shares at $80 to reduce the overall average price. And meanwhile, while doing that, we can keep collecting the premium to reduce the price as well, right? We are not, in this game, we're not doing cash secure put so that we don't get filled, right? The idea here is we want to get filled because we feel that this is a good stock. If we liked it at $100, we definitely like it at $80. So that is the mindset that you want to get into as you do this cash secure put. So now that you have collected $2 in credit, again, this reduces the cost that you paid for the stock. So now it becomes $96. So let's say again, the stock moves and at expiration date, it closes below your strike price. At this point of time, your cash secure put will be exercised. So at this point of time, you will need to buy the stock at $80. You need to buy 100 shares and put up $8,000. So right now, your effective price, your average price becomes $88. So as you can see, we have lowered our average price from $100 to $88. So this is the whole idea of using the cash secured put to repair your stock. You get a lower average price. So this time, if the price was to rally back up to our original price, which we bought at of $100, now we would actually be sitting at a profit of $12 per stock. And now, instead of being break even, we actually have a profit because our average price right now is $88 and we have 200 shares with $12 per share profit. So that's roughly $2,400. So as you can see, we have used the cash secured put to increase our profitability, as well the reduce the average price. So if the price was to just go back just to the price that we entered at, we would even profit. Okay, so here are 5 steps to repair your stocks using the cash secured put. So step 1 is to first identify how much more funds you can allocate to the stock. Again, very important. Money management is very important. You don't want to put yourself in a position where you do not have enough money to fulfill the assignment of the shares, and then your broker may have to liquidate your position and you have to cut loss when your intention is to hold on to the stock. Step number 2, you want to identify the level or levels at which you want to buy the stock at, and it's either at the price level or percentage level. So for example, if you bought at $100, you may identify the next level that you want to enter, say at $80. So that's the price where you want to sell the next cash secured put, right? Or you may say it's in terms of percentage. So for me, I like to see it in terms of percentage. So for example, I generally, if I want to repair a stock, I would like to have 2 levels from after my entry level. So makes a total of 3 levels. So my entry level, the mid level, and the last level to finally average in for my stocks. So how I will determine the last level generally would be always around the 50% level, because normally that's the time where stocks, most of the time stocks do not really drop all the way to the 50% level unless it's like a market crash or bear market. So if the stock can actually drop to the 50% level, it is actually a very good price to get it and to get in at. Considering that the fundamentals hasn't changed, your view on the stock is still there, then getting in at the 50% level is a very good entry price. So that is where I want to lock in the final level for my cash secured put. So if it goes to that point in time, I'm definitely going to want to get in. So the first cash secured put that I'll be selling will basically be the midpoint between the entry level and the 50% level. So let's say, for example, I entered at $100. I might see that the 50% level for me would be at $50, right? So in this case, the midpoint would just be $75. So if right now the stock is somewhere around $90, I'll be just waiting to sell the cash secured put at $75, and I'll keep doing this, sell this cash secured put until it finally get exercised. If this is exercised, I'll be looking at the next cash secured put, which is at $50. Okay, so step number 3 is to look for the options with the days to expiration of 30 to 45 days, because that is generally the time where the decay starts to really increase. It's always the last 30 to 45 days of an option. Now, some people have actually asked whether they can sell the weekly options for this. Now, you definitely can, but bear in mind that if you were to sell the weekly options, chances are that you may not get enough premium to sell at the strike price that you want. So let's say, for example, the stock may have dropped to $90. And if you were to take a look at the options with 7 days to expiration, you might find that the strike price at $75 may not even give you any premium. So you can't sell until the stock drops much further. So there is a trade-off there. While it gives a higher return on your investment, the thing is that you may not even get any premium until the stock goes much lower. So meanwhile, in between, if the price is hovering around $90, you may not be selling anything. You may just be sitting in your hands waiting for the price to drop further. So this is the trade-off. So generally, when you do a repair, especially when your price is quite far away, you might want to consider doing the days to expiration with 30 to 45 days left. So step number 4 is to wait till the desired level is at least more than $20 to sell the cash secured put. That's because if you were to look at the option chain, most of the option premium that you want to get is more than 20 deltas. That's where you get more premium. Anything less than that, under 20, maybe even $10 or 5 deltas, you get very little. So if you're okay with that, you definitely can go ahead, but you're definitely not getting a lot. So rather than sell, the strike price at 5 deltas, I would rather wait for the stock to drop a little bit more, and once it becomes 20 delta, then I will start to sell. So that means that I might just have to wait a little bit longer. The stock might just go back up, and if the stock goes up, I might have missed out on selling the 5 delta for some little premium that is giving. On the other hand, had I sold the 5 delta put, if the stock was to continue to drop further nearer to my strike price, it would have been a wasted chance for me, because I could have sold it, I could have waited a little longer and sold for a higher premium, which can help reduce the cost basis of my stock even more. Right? So in general, I like to wait until it's at least more than 20 deltas before selling the cash account put. If it's lower than 20 deltas, I would choose to wait. There are even times I would like to just sell it when it's at the money at 50 deltas, because that's the most extrinsic value that you can get, right? When you get a lot of extrinsic value, it can help really offset the cost basis. So again, this is a personal preference. There's no hard and fast rule what you should do. The main idea of this cash to call put is that you want to get filled at the levels, the strikes that you feel that you sold at. Okay. So finally, step 5, if it expires worthless, all you have to do is just rinse and repeat, just like the visual illustration I showed you earlier. Just keep selling until finally you get the 2 levels that you want filled. Alright guys, I hope this has been very helpful for you. This is part 1. Part 2, I'll be releasing it again in the next few days, so look forward to that. For now, if you have any questions, please feel free to leave in the comments below. And if you like this video, you think that it has been very helpful for you, please give me a thumbs up, and also please subscribe so I can create more videos like this for you. Alright guys, I'll see you in the next video.